Hello, this is going to be Chapter 14, Financial and Accounting. We're going to go over the ideas about what accountants do for a living, how financial statements are calculated. All businesses need to collect information about their financial performance. So this is basically how they put everything together so that they can pay taxes, understand how much their revenues are going to be, what their profits are going to be, and what they can do with the money that they have left over in order to invest it or to redistribute it in whatever way they see fit to become the most profitable entity that they can. You need to know how much money you've got, so that's what this chapter is about. Let's take a look. Chapter 14 is accounting and financial statements. If you go to slide 2, it basically just gives you an overview of what accounting is. In the business sense, the word account is based kind of on the word count, which is to add things up. To keep an account is to keep a documentation or a record of everything that you're doing. It's a report or a description of some type of an event or an experience. And in a business sense, that's a record or statement of your financial expenditures, things that you've spent on, and receipts, which are documents that prove transactions have taken place over a particular period of time. To be held accountable is to be able to explain yourself, to justify an action or a decision that you've made. And if you are held accountable, you collect the information to be able to determine or to show proof that what you're taking the action on is backed up by actual proof. So along those lines, accounting is the process of keeping all of your financial transactions recorded for later use. Now, the way that you do accounting can vary from place to place. In 1973, the Financial Accounting Standards Board created the principles for accounting. It's usually known, if you take an accounting class, as the Generally Accepted Accounting Principles, or GAAP, GAAP. The Generally Accepted Accounting Principles are an attempt by the profession of accounting to establish standards so that everybody can collect information in a uniform function. If you were going to manage your own business, you may collect receipts and keep track of the expenditures that you have, and you may develop your own system, which may be completely different from another company doing the same thing. And if you had to pay taxes or if somebody wanted to buy your organization, they would want to look at your books, the records that you have, to determine whether or not it's a profitable endeavor. If you keep your records in a way that other people can't understand it because the standards that you use are different, that would slow things down. So the generally accepted accounting principles are what the industry or the professional accountants really try to ascribe to or partake in order to make sure that they're all doing kind of the same thing so that you're comparing apples to apples when you look at one company's reports versus another. The SEC, the Securities and Exchange Commission, we talked about in Chapter 4 because they regulate publicly held or publicly traded corporations. They also have rules about accounting because, as we went over in class earlier, if you are a publicly traded corporation, you have to report to the public what your income is, what your profit was, what your loss was, so that people who buy that stock will have information to help them determine whether or not it would be a good purchase. You are required to make that information available, and you have to comply with the GAAP so that everybody who's taking a look at a publicly traded company would be able to determine whether or not it would be a good buy. You can go to school for accounting. You can get a degree in accounting. You can also get professional certifications. So once you actually get a degree in accounting, you can do some further study and take some exams. While there are some laws and regulations like the Securities and Exchange Commission would enforce, a lot of the conditions that are present in the accounting profession is regulated by themselves. So, for example, I'm an attorney. I had to take the bar exam. The Massachusetts Bar Association or the Board of Bar Overseers are the ones who actually give you the bar exam that you have to pass in order to become a practicing attorney. In the world of accounting, there are various certifications that you can get, among them CPA, CFA, CMA, and a few others. CPA stands for Certified Public Accountant. A CFA is a Certified Financial Analyst. A CMA is a Certified Management Accountant. You can be an EA or an enrolled agent. That means that you can do tax work for the IRS. And you could be a CIA, not the Central Intelligence Agency, but a Certified Internal Auditor. What internal audit is, well, first of all, what auditing is to review all of your books to make sure that they're being kept up to the standards that you would want. An internal audit means that you're auditing your own books before the IRS or the Department of Revenue, the DOR, does an audit. If you are subjected to an audit, that means the government tax collectors will come and look at all of your books to make sure that you filed your paperwork appropriately and you paid the sufficient amount of taxes. In order to avoid an audit finding, which means you could face fees or penalties or fines, you could do an internal audit to make sure that you're operating in a sufficient manner so that you don't have any exposure if there is an actual audit conducted by the government. You could also have an audit requested or an accounting requested by people that you owe money to, your creditors. If you are going to loan money to someone, they may want a certified financial statement to justify how much money you're actually making. If I walk into a bank and say, I want to borrow some money, they'll say, sure, but they're going to want to make sure that I can pay them back. And I could promise that I'm paying them back. I could get an independent third-party accountant to give a certified statement that, my books are in order and that I am making enough money, so that could help reduce the risk of giving a loan to someone. You can make sure that they're going to be able to pay you back. On slide 3, they talk about a certified public accountant. So this is someone who has been state certified through the organization that they go to. One of those organizations in Massachusetts would be the Massachusetts Society of CPAs. This is a professional organization that helps their membership figure out what kind of training they need, continuing education, so that they can stay on top of any changes on the law that may take place. The Massachusetts Society of CPAs is actually run by Amy Pitter, who was a previous commissioner of revenue for the state of Massachusetts. So in order to become a CPA, you have to get a degree in accounting, and then you have to study up for it. You have to take a test, which is fairly competitive. And when you get that certification, you are entitled to put yourself out as a CPA and get a job as a certified public accountant. You would help prepare financial records, file tax returns, do audits, internal and external and the like. And CPAs are typically self-employed, or they could work for a large accounting firm. We'll talk about some of those in a couple more slides. Slide 4, this is a little bit dated information. I need to update the slide, but the idea is the same. You take a look at some of the bigger firms. The first one is Ernst & Young, LLP. They are a limited liability partnership, so you should all know what that is by now. Eventually, it probably started off with a guy named Ernst, and he partnered up with someone else named Young. They created Ernst & Young. They became an LLP. They paid the fee to become a partnership that has limited liability. And you can see that they were ranked number 1 in the most recent year on this, which was about 7 years ago. But they made $22 billion in terms of revenues. That's not profit, that's revenue. They probably had a reasonably good profit if they operated efficiently. They're located in New York. Grant Thornton has been a couple of years at the top on this list. They're a relatively small firm in comparison to Ernst & Young. They're in Chicago, and if you look at where they're all from, New York, Michigan, Seattle, Chicago. Those are the top 8, at least on this list. If you think about it, the domination of New York with 5 out of the 8 doesn't really come as much of a surprise. It's a huge financial center. Wall Street is in New York, NASDAQ, the Dow Jones, the New York Stock Exchange. A lot of banks are in New York, etc. Chicago is another big city. It's located in the Midwest. They have a lot of mercantile exchange out there. They have their own stock exchange. They are kind of the economic hub of the middle of the country. If you go to Michigan, it may be surprising that you see something from Southfield, Michigan. It's probably close to Detroit. Detroit does have the big 3 automakers. If you go to Seattle, you've got companies like Boeing, Starbucks, Microsoft, Apple. So there's a lot of companies out there that would probably require some of these firms to be able to help them do their work. And again, Chicago is also on the list again. So some of them making, close to $30 billion a year, and this is dated information. It was probably higher than that as the economy recovered after the last recession. On slide 5, they talk about accounting scandals at Enron and WorldCom in the early 2000s, which was almost 20 years ago. But there were huge scandals because people were basically running accounting fraud. As a result of the fraud from companies like Enron and WorldCom, Congress passed the Sarbanes-Oxley Act, which really required a lot more accountability in terms of the accounting practices and reporting practices. What Enron was doing, they were an energy investment company, and they would have people buy stock for them because they could promise a guaranteed return. However, they weren't really making money in a return. They were basically just lying in their reports. Their accounting was saying that they were making a profit when they really weren't. Accounting fraud is not a new thing. The internet and the accessibility of buying stock from companies all around the world through globalization makes it a much bigger problem because a lot more people can be taken advantage of. When they say things like cooking the books, that is basically a euphemism for accounting fraud. And when they talk about the books, literally before, people used to have paper. You would have a book with a ledger on it and you would keep all of your accounts in there. Obviously, not many places use books anymore. They use Excel or various types of software that handles accounting for it. SAP or SAP is an accounting program that is sold by the company all over the world. It has become such an accounting standard that they actually offer courses in SAP in a lot of colleges. So if you're an accountant, you will probably become familiar with it. What Enron was doing is they were selling stock on the basis of fraudulent accounting reports. A lot of people went to jail. Ken Lay, I believe, was the CEO. He ended up going to jail. I believe he died in jail of cancer, so he didn't have a very good end. The Sarbanes-Oxley Act did require a lot more oversight. I was actually offered a job at Fidelity a few years back. My job would have just been making sure that they complied with the Sarbanes-Oxley statute. Unfortunately, that was during the recession, and the Friday after I got the job offer on Monday, I heard on the radio that they had laid off about 5,000 people, and my job was prospectively one of those that was included in the layoff. So I didn't actually take the job and get laid off, but my job kind of went up in smoke as a result of it. But they were going to hire somebody, and they probably did ultimately, to be able to handle all of the paperwork required to be able to comply with these new standards. As we saw in the movie that we watched in class during, I think, the time that we had scheduled for that first exam, there was a lot of bank fraud that was going on, people giving out loans to others that they knew weren't really going to be able to pay them back. They passed the Dodd-Frank Act, which was named after a couple of people in Congress. It strengthened the oversight of financial institutions, banks, to make sure that they had the information required to prove that the bank's loans that they were handing out were not going to be without proper vetting to make sure that people could pay the money back, so that when they put them into these bundled securities, it wouldn't create the type of risk that would result in a financial disaster like happened after 2008 and 9. Slide 6 just breaks down a couple of terms that you should be familiar with. Forensic is really a term that means that you're going to be applying scientific methods to investigate potentially a crime. So forensic accounting, you would be looking at maybe after the fact, when you found out that Enron had some trouble, you need to get a bunch of accountants who understand how to go in and do a review to figure out what went wrong. It would be almost like a crime scene forensic investigation, but it's for money, it's for accounting purposes. The FBI actually hires a lot of accountants to do this type of thing. If you think of some of the biggest criminals in history, Al Capone is a famous mafia kingpin from Chicago in the 1930s. He came into power after they passed prohibition, which meant that you couldn't sell alcohol legally in the United States. He would import alcohol from Canada, sell it illegally through various means. It was basically the drug deals of the day. And he made a lot of money. And they never got him for all of the murders and other things that he did. But he ended up going to jail for tax evasion because he made a bunch of money and he couldn't prove where it came from, and he hadn't paid taxes on it. He also died in jail, so maybe it's a good idea not to commit accounting fraud. The second bullet does mention cooked books, so sometimes if you're running a scam or you're having a criminal endeavor, you would have one set of books where you keep the right information that you would show to the IRS and the DOR to show that you actually have legitimate businesses, but you also need to know who the criminals are who owe you money, and you'd keep another set of books for that. Cooking the books basically means that you're also potentially just making false claims. So if I went on a business trip and had the ability to claim a legitimate expense, that's fine. But if I took my family to Disney World, I think I mentioned this in class, and I handed out a couple of business cards in 10 minutes over lunch with somebody, the rest of the time that I went there, I cannot claim a business expense for the $5,000 that it cost me to go to Disney World with my wife and kids. That is not a legitimate expense. If I deducted it from my revenues at my company, that means I'm using the money that I made and not paying taxes on it. All that money that goes into my company is a legitimate source of revenue, and I can reduce that amount through legitimate expenses, and what's left over is my profit, which has to be taxed. If I inflate my expenditures, I make it look like I haven't made as much money, and I can pay less taxes on it, which is tax fraud. Forensic accountants have been around since the 1930s when the FBI actually went after Al Capone, but a lot of auditing firms do it as well because they want to make sure their own staff isn't ripping them off. There is another type of certification you can get, and is a certified fraud examiner, and there's more than 60,000 people that have that certification because as it has become a bigger issue, more firms are interested in making sure that they're in compliance with the state and federal laws and that the people that work for them are not doing anything untowardly. Slide 7 covers private accountants. These are people who work on staff for large companies. They can work for government organizations. I work for the government. We have a few accountants working for us to make sure that our statements that come in, money coming in, money going out, is correctly collected and reported in the appropriate fashion so that we can do our budgets. Certified Management Accountants is a CMA. That's another test that you can take. These are private accountants who usually work for a private firm. When you're a CPA, that means you can work for anybody. So you would open up your own firm and you would have various clients that would come to you. If you're a private accountant, you usually only have one client and you'd be working for them. Slide 8 talks about the difference between accounting and bookkeeping. They are closely related, but they are not the same thing. Bookkeeping is really just establishing the information flow. If somebody comes in and buys something from you, you'll print out a receipt, they'll get their copy, you put your copy in the book. Eventually that receipt gets entered into your online or your digital version of what a book is today, and you put it in the ledger. And then you add up how much money came in, and that's your bookkeeping. You're basically literally keeping the book. You're adding up all the money that came in, all the money that went out, tracking all of your transactions. What that does is it creates a pool of information that accountants would then look at to analyze it. I took a class a few years ago and it made a very interesting point. There's a difference between data and information. Data is the aggregation of all of the documents that you have that supports the transactions that have taken place. By themselves, they don't mean anything, but when you add them up, they create information because they can tell you how much money you made this month. Data would be a receipt for $500. Information would be all of my receipts for that month so that I could find out how much my revenue was, how much my income was for that month. And then I can do a monthly chart for the entire year, and I can do a cash flow to show how much money came in during various months. And then as a manager, I can take that account information and make decisions on it. You can't do that with just the bookkeeping data that has been collected. You have to use that information and put it into some type of a format that you can actually use to make business decisions. That's where the accounting part comes in. Slide 9 shows the use of it. So you've got business activities, they conduct accounting. Who's going to look at it? Management, owners, board of directors, the people who are the officers in the company, managers, department heads, supervisors, people with a direct financial interest, your stockholders, investors. If you're an LLP, these could be your silent investors, your limited partners, even if it's not an LLP. Present or potential creditors, the banks and the people that may be looking to loan you money, they want to see your accounting information. People with indirect financial interest, these are the IRS and the DOR. At the federal level, it's the IRS. At the state, it's the DOR, the Department of Revenue. You could have a municipal organization that also has taxes that you have to be able to file information with. Regulatory agencies like the SEC and the stock exchange, if you're a publicly traded corporation, you will have to file your reports using the generally accepted accounting principles with the SEC. If you are listed on the New York Stock Exchange, you will have to file a whole bunch of information with them too to justify that you meet the minimum standards to be listed on the stock exchange so that you can be traded with everybody else. Economic planners, the Federal Reserve Board may want to look at some of the accounting information from various companies to figure out whether or not they need to raise interest rates or lower interest rates because they're looking at how the economy is doing. All of that information is basically going to be reviewed. Actions are then taken on the basis of that information, which leads to ongoing business activities, and the cycle repeats. Slide 10 talks about the internal uses of accounting. Your managers need to know how much money they have to spend. They also need to be able to collect information so that the accounting staff can determine how we're doing. I have a budget this year. How much money have I spent? How much money am I going to need? All of that will go through managerial accounting. One of the biggest concerns of most companies is cash flow. How much money do we have coming in versus how much money has to go out to be able to cover our expenses? New companies typically have a big problem with cash flow because if they don't have a lot of new customers, it's going to take you a while to build up your clientele. Therefore, it could take quite a while for you to be able to get a secure level of income to come in to cover your expenses. New companies, it's very important for them to have money in the bank because you may not have enough revenue coming in to support the expenses that you have. You may need to tap into your savings. If you have a sufficient cash flow to cover your expenditures, that makes things a lot easier. But the way you figure this out is to do your basic accounting assessment to determine how much money is coming in. Slide 11, again, more internal uses. We have to create a budget. This is basically an expectation of how much money we are going to spend next year. We would typically look at last year's budget to figure out how we did, last year's profit or loss to figure out how much we could allocate going forward in the future, how much money we have coming in through the sale of stock or other sources of revenue, whether it be getting a bond, selling stock, having other investment, revenue, sales, etc. What we look at is cash inflows and outflows. Whatever's left over, our accountants can start to figure out how much money we can really safely commit to the future. Now, budgets usually have to be amended during the course of the year because we may be in the middle of a giant recession. Let's say there's some kind of a pandemic that causes us to shut down. Our money coming in is going to be much more short of what we were expecting, so we're going to have to revise the budget. In better times, we may make a lot more money than we thought, and we would have to adjust the budget that way too. Hopefully, though, things are just kind of chugging along as expected. We wouldn't need to have a whole lot of amendments or changes to the budget, but we still need to do a budget because I have to have an understanding of how much money I'm able to spend each month. I don't want to overspend in one month and then be short the next. So having accounting information will help us plan appropriately for the future. Slide 12 talks about the external uses. This is again reporting for income taxes, proving that your expenses are legitimate so that you're paying the appropriate tax on the profit that you've made. You may need to get credit from various sources, whether it's an angel investor, a venture capitalist, getting a loan from a bank or for some other financial institution. You may have to file annual reports if you're a publicly traded company through the SEC. Those reports are going to have to be audited, probably by an independent certified financial auditor or accountant. Slide 13 is a pretty quick thing, just telling you why you would look at an annual report. I would recommend that you go to Google and just think of a company that you have an interest in and type down the name of that company and write annual report. If they're publicly traded, it'll pop up and you can review the type of things that are in there. As you can see in the picture, there's a lot of pie charts, line graphs telling you how much the revenue was, how much the losses were. And by the way, typically you can see on that chart where they have got the line chart where you see green, that's typically indicating a profit, whereas red would be a loss. In the old days, black would be the ink that would be used to show that you made a profit. Red would be a loss. If you hear a company say that they're bleeding red ink or they're bleeding red, red being the color of blood, if you have a lot of losses, you could say you have a lot of red ink. That's a bad sign. If you're making money, you would be in the black. There was a song by a rock band called AC/DC a few years ago called Back in Black. Really all it means is he's back to making money. On slide 14, if you've taken accounting, you probably know this. You may have nightmares about it. It's called the accounting equation. It's an equation because there's something on one side of the equal sign that has to equal the amount on the other side of the equal sign. In this case, assets, which is all of the things that is owned by the organization, whether it be a corporation or whatever kind of a company format you've got, that has to equal the liabilities, things that you owe, plus the owner's equity, the things that the company owns outright. That's how much your assets are. If you're talking about figuring out what your net worth is your liabilities and your equity. So if I have $1 million worth of assets, it really has to exclude my liabilities because I may have liabilities of $500,000. Therefore, my assets are really only $500,000. So assets are your economic resources, things of value that you have. Cash is liquid, so that's one thing you can cover. Use your bank accounts. Inventory, things that you've produced that have value that you haven't sold yet. Land, equipment, buildings, anything else that is tangible or intangible. An intangible asset could be a copyright, it could be a trademark, it could be the goodwill or the reputation in your name. If you remember, we talked about Circuit City. When they went bankrupt, they sold the name Circuit City along with the logo. That had value, that was an asset. Fortunately, they went bankrupt and had to sell it during their liquidation sale, but it was something of value and it is something that can be included in assets. Liabilities are what basically you owe to everybody else. If you have a building and it's worth $1 million, but you have $500,000 in liabilities, that's going to be listed under your liability category. Owner's equity is what you actually own less the liabilities. So again, in that example, if I have $1 million building with $500,000 in liabilities, my liabilities is $500,000, my equity is $500,000, it adds up to $1 million. The accounting equation can be best exemplified using this example that they gave you. There's a flower shop owned by Anna. Creatively, she called it Anna's Flowers. So the assets of Anna's Flowers, it can be all of the things in her storefront, the counters, the refrigerators, display cases, flowers, vases, cards, the wrapping paper, anything that you could basically have of value that is in her storefront. Her liabilities could include a loan, in this case from the Small Business Association or the SBA, money that she owes to the flower people that she bought the supplies from. She might have bought them on credit and she has to pay them back as she sells. We talked about that before. You can get a credit on the inventory that you get in if you're selling it at retail. So if she were to liquidate her business, meaning that she would convert all of her assets to money, which can flow a lot easier, liquid, then any money left over is really what she's got in terms of owner's equity. Go to slide 16. We talk about the concept of double entry bookkeeping. Now, this might be a little bit confusing at first, but you basically have to enter in everything in the appropriate category. Usually it's going to be twice, which is why it's called double entry. So if you have a system of recording, even if you're talking about just balancing your checkbook, which most people don't do anymore because the bank does it for them, but in the old days you would have a check register and you'd have to balance the money coming in and the money going out. You would put the money that you had coming in, and if it was not a cleared check yet, you'd still have to keep track of it until that check cleared. Then when it did clear, you would make sure that it added up appropriately. So in the example here, Anna buys $325 of roses on credit. She records the $325 as a liability because she has to pay it back. But the assets that she's got, the roses that she actually got in return for that $325, that has to be accounted for as well. If she only listed it as a liability, it's going to look like a loss of $325. But in reality, she spent the $325 in order to get the roses. So she has to count the liability as $325, but she also has $325 in assets. And if you look at the accounting equation, they equal the same. That's the whole point of this. That's where you get the double entry leads to the accounting equation. When she sells those flowers, probably at a retail markup, she will make a profit. And we'll show you how to do that on a subsequent slide. Slide 17 shows the purposes of double entry bookkeeping. So the balance is how much money you have at hand at any given time. It's basically in order to keep the balancing equation, you have to put the two separate accounts, whether it's a liability or an asset. You have to classify everything that you're doing appropriately, whether it's owner's equity, liability, or assets. And then you break it down into cash, inventory, and equipment, which we'll see in a second. Slide 18 gives you this double entry bookkeeping. So again, if you take a peek at it, hopefully it shows up on the video. If not, you can go to the slides that have been put up on Moodle and go to slide 18. You can see the cash invested by Anna is $2,500. She got a loan for $5,000 from the Small Business Association. She purchased furnishings, which cost $3,000. So her cash went down by $3,000. But the equipment that she got in return is worth $3,000. So she has a negative $3,000 under cash because she had to take it out, but she has $3,000 positive in terms of equipment. If you go back up to that first line again, the cash that was invested by Anna, she does have access to that money, so it is listed as cash, but it was her own money. So if you go to the far right-hand column, that's her owner's equity. That's her money. The loan that she got for $5,000, that's also cash on hand, so that is an asset. If you go to the next to last column on the right, that's a loan, which is listed under liabilities. So you can see everything that is added in the asset column has a corresponding line for the double entry bookkeeping in another category so that it balances out. The next one down is the purchase of inventory. She spent $2,000 of her cash, so that's $2,000 out of there, but she has to add it in the inventory column because it's been converted from cash into something of value. She bought roses for $325. She bought it on credit, so she's got $325 in inventory, but she owes that money under the liability column to her suppliers. Then, here's where she makes some money. She used that money that she brought in herself, plus the money that she borrowed or purchased other things on credit. She sold $2,000 worth of roses with a markup. How much did she lose out of her inventory? $1,500. What's the difference? Well, that's her profit. That's what she gets to keep. So you can see on this one, the first month's sales is $2,000. She lost $1,500 in inventory, and she kept $500 in her pocket. So that's her equity. If you add everything up in the cash, equipment, and inventory columns, she's got $8,325. If you add up all the double entries in terms of liability and owner's equity, which consist of debt to suppliers, loans, and equity, that also adds up to $325. So her accounting equation balances out. If she had $8,500 in one column and $8,000 in the other column, she made a mistake somewhere, and she'd probably have to spend some time going through her records to figure out where she made a mistake. She's got to get those things to balance out, or some of the money that she's got is going to be lost, and she's either going to not be able to track money that she made, or she's not going to be able to track money that she has to pay back to other people. Either case, that would be a bad outcome. Slide 19 is basically just an overview of the accounting cycle. It's a 4-step process, which we'll look at in detail on the next slide.
So in 20, the first part is to get that documentation, kind of the bookkeeping. So you show the documents that have the transaction. Somebody comes in and buys a $500 bouquet and you give them $250,000 in terms of consultation, what you can do. That's $750. So you give them a receipt for that. The step 2 is you take that receipt. The party that paid for it would get a different copy, probably the yellow copy if you have one of those carbon copy versions of it. You keep the white copy, and then you take that and you add it into your book, into the journal. And the journal is basically just very traditionally how you do it. If you've ever seen A Christmas Carol, the famous story at Christmas time with Charles Dickens, Bob Cratchit, his employee, that's basically all he does. He keeps the books. He writes all the money that comes in and all the money that goes out. The accounting process on slide 21 talks about step 3, which is actually breaking it down a little bit more. So you put all of the information by date, the explanation of what it was, how much money came in, why it went out, whether it was credit, debit, what the balance is. This is typically done on a computer today, and it really leads to collecting all of that data and start turning it into information that you can use. The next slide is the step 4, where you take all of that information that you've collected, and then you start to run some of the types of things that you can do that an accountant would come up with. So an income statement is the first thing you would look at. How much money came in, revenue. Net sales, $123,850. Consulting, she made $73,850. Total revenue is $197,700. Her expenses, cost of goods sold, selling expenses, that's probably advertising, general and administration, maybe she had to pay rent, she had to buy various supplies, etc., pay for the internet. Other expenses, just miscellaneous things that popped up. Her total expenses were $134,300. You take the total revenues, you subtract the expenses, her net income is $63,400. You could not do an income statement unless you had the first 3 steps being completed to get all of that data collected. So that's the bookkeeping part leads to the accounting part. Let's skip over to the third one on the right. That's her annual budget. So you can see she's got sales, consulting, and the total that she expects to make. This is basically something that you would do in the future. She would probably base it on last year's revenues that were coming in, so she can get an idea of how much it's going to be. She would use this number, and you can see the numbers are the same as in the first box. That was her budget for last month. She could do the budget for the next year on this basis as well, so she could get some kind of an idea. If she's got a seasonal business, maybe some months she makes more money, she'll be able to plan out her budget. She'll be able to make sure she doesn't spend too much money in a month when she's not expecting to get a lot of revenue, and vice versa. She could spend a little bit more money when she thinks more money will be coming in. Interestingly enough, I kind of disagree with the example that they gave, because February she should have a lot of sales because of Valentine's Day. I would expect the same in May or June whenever Mother's Day falls. And probably between April and October, there's probably a lot of weddings that come in. Maybe not a lot of things in November and January. And you can see that it does drop kind of precipitously on her sales. So you can kind of tell if this was a ski resort, for example, your winter months would probably have a lot more money there. And you need to know that so that you can plan ahead and not spend too much money when you're not going to have a lot of money on hand in terms of cash flow. Slide 23 talks about financial statements. That's the previous slide that we were talking about. You have a whole lot of different types of financial statements. You could even create a few that would be more appropriate for your particular business. If you're following the generally accepted accounting principles, however, you're going to use the ones that are typically used by accountants everywhere. And these are the types of things that you would want to be able to share with other people if you needed to sell your business or to show to investors, for example. You want to have the same type of accounting statements that other people could use. Just be aware on that last bullet, some of the terminology is synonymous. So sales and revenue basically means the same thing. Profits and income, this is revenue after expense. They kind of mean the same thing as well. So it depends on the nature of the vernacular of a particular company, what they are using. Slide 24 goes through that. I'm not going to mention it here. You can just read through it, but it just shows how sometimes terminology can be confusing because different terms can mean the same thing. Slide 25 talks about an income statement. Again, we already looked at one. So how profitable have you been during a particular period of time that you're analyzing? Your profit or your loss, either black or red or green, depending on what kind of a program you're using. A revenue statement on slide 26. This is just showing before your expenses how much money you expect to have coming in. This can include rentals and lease income, anything that you have that's coming in as revenue. If you have Anna's Flowers, she may have money in the stock market that she's invested in something else. She may own the building where her store is located in the front of the first floor, but she may have apartment revenue upstairs too, and that would all be included as well. Slide 27 talks about the cost of goods sold. This is another equation that you could use. And I'm not going to give you a test about this. If you've taken accounting, you've probably gone through the nightmare of all of these formulas. You would look at the cost of goods sold, which equals your beginning inventory, how much you've purchased in the meantime, and how much you're left with afterwards. Basically, it calculates the cost of producing the goods, your raw materials, the labor that you had to be able to add value to it, and the expenses associated with production to find out how much it actually costs to make your products. If the costs are too high, then maybe you need to look at using that information to go back and make more efficient processes to make your products a little bit cheaper, which would make you more competitive in the marketplace. 28 talks about gross income. This is before expenses, so revenues minus the cost of goods sold in order to generate the revenues. Gross income or profit is revenues minus the cost of goods sold. It just shows you how much it costs you to make the money that you're bringing in. Expenses are the costs incurred through your day-to-day operations. We've kind of already covered that a few times during the class, so that should be fairly self-explanatory. Slide 29 is your income statement. You're really looking at everything you've sold, whether it's a product or a service, any general money that's coming in, administrative expenses, research and development, engineering, any other types of expenses, interest expenses. If you've taken out a loan, that is an expense as well. So if I have a building that I owe $500,000 on, I am paying it back and I'm going to get my equity, but I'm also paying interest to the bank, and that is an expense. Depreciation is the calculation of how much something loses value. You can have appreciating assets, which means that they gain value, or you could have a depreciating asset, which means it's losing value. Just as an aside, if you're going to buy a car, by definition, if you're using that car because it's not a classic car that you're hoping is going to go up in value because you're not driving it and it's in demand, that may be an appreciating value for the car, but most cars that you use depreciate with value. If you're buying a depreciating asset, you probably don't want to buy it on credit because that means you're paying a premium. You're paying more money than it's actually listed at. If you buy a $30,000 car and you pay interest on a loan, you're actually paying $35,000 or $40,000 for that car, and when you're done using it, it's only going to be worth a fraction of what you actually paid for it. If you have a depreciating asset, you probably want to pay cash if you can. If you're in a company, though, and you have to spend millions of dollars on plant materials like an assembly line or equipment, machinery, they may be depreciating assets, but they also produce revenue. So it's not exactly the same. Even though the value of it can go down with wear and tear, you can still use that equipment to make money. Same with the car. If you have to deliver things and get from point A to point B, there is a benefit to having it, but it is offset by the depreciation. If I'm doing an accounting equation, my assets may drop over the time, and I may have to pay less taxes as a result because the amount of money that I'm worth could drop if I use the equipment and it goes down in value. So my equity could drop if the equipment that I have goes down over time because I'm using it and it becomes more run down. The income statement is noted on slide 30. Net income is your total profit or loss after you've done all of your expenses, including taxes and other fees. Companies pretty much look at the current year's results and they look at the previous 2 years to be able to get a sense of how they're doing in terms of net income so they could forecast their budget for the following year. If you don't keep the net income, if you're a corporation or some other form where you have to pay your investors, dividends are paid out as well, and that is not included in the net income. Slide 31, again, talks a little bit more about the income statement. I'm not going to go through all of that now because this is kind of a long PowerPoint set, so just read through that. It kind of explains everything that you need to know. Slide 32 talks about the balance sheet. This is a quick snapshot. You can do a very quick accounting equation and show where you stand today. How much money do we have? Basically, your assets still have to equal your liabilities and owner's equity. You can do it for today, you can do it for the last year, but it really gives you a quick understanding of where you stand right now today. How much money am I going to have? Am I going to make it through this pandemic? I could do a balance sheet at the beginning of the pandemic, in the middle of the pandemic, and at the end of it, so I can figure out what I need to do to take action to preserve my assets so that I don't go into bankruptcy once this is all over. Some of the things that you can look at on slide 33 are current assets. These are assets that you can use now, or you can convert into something that is usable, i.e. cash, within the course of a calendar year. If you have an assembly line, you have property and fixed materials to it, that's not something that you may be able to turn around very quickly. Those are not current assets. Money in the bank, accounts receivable, money that people owe to you, that's current assets. You can actually sell the accounts receivable before people even pay you. So for example, I'm running a business and I sold something to a client and they haven't paid me yet. That's an account receivable. They owe me money. They have 30 days or 45 days or 90 days, whatever the time period is through our agreement. That is money that I am expecting to make. Unfortunately, there's always going to be a certain level of default, meaning people will not pay me back everything that they owe me. Maybe there's a 3% default level. Depending on the business, it could be as high as 7 or 8%. If I need money right now because I have to pay the rent, I could sell my accounts receivable, which means I would give someone else the right to collect the money that is owed to me. If I am owed $100,000, I could probably expect to collect $97,000. I might be able to sell it for $70,000 to someone else because I need cash right away. They can make a profit at that of $27,000. I'm going to lose some money, but in return, I don't have to spend the time collecting all the cash from the people who owe me money. I get $70,000 right now that I can use. Slide 34, just take a peek. It's a nice picture of some John Deere tractors being assembled. Slide 35, some more balance sheet issues, current liabilities. You can look at the firm's obligation to short-term creditors, how much you have to pay back within a year. Accounts payable is the opposites of account receivable. I've purchased something and I haven't paid them for it yet. This is money that I have to pay back to someone else. It is a liability. But if it can be paid back within a year, that could fall under current liabilities as well. If I have a mortgage for 30 years, that is not an account payable. That would be a current liability. Accrued expenses are all of my unpaid financial obligations that I've got, not necessarily on an account for some type of a product or service that I purchased, but it could be some other things like my loan installments on a piece of equipment that I've purchased. If it can be done within a year, it's current. If not, it's a longer term liability. Slide 36 covers owner's equity in terms of the contributions that you've got with retained income. Owner's equity can be very different from company to company. I may have a lot of money that is just sitting in my cash accounts. I may not have a lot of cash because I've reinvested it in my company, or I've taken out a lot of loans because I'm in a period of expansion. I may be waiting for stock to sell. I may have a lot of stock buybacks. So you need to really be able to look at the balance sheet if you're going to determine whether you want to invest in a company or not. The one thing that these types of accounting statements do is they're kind of a great equalizer. If I've got the interest in buying stock in a local company that has revenues of a couple of $1 million a year, should I buy stock in that company or should I buy stock in McDonald's, which is a multi-billion-dollar global company? I can still look at the balance sheet for both, and because they're going to be using the generally accepted accounting principles, I can make a determination as to whether or not one company is performing at a high level, even though they may be in completely different sectors and they have different levels of revenue and profitability. I can really start to check them out by comparing the same type of accounting statements that they've got. Statement of cash flows on 37 is how much money coming in, how much money going out. We'll get to that in a little bit more detail, so I'm going to skip ahead. Statement of cash flows includes cash from operating activities, cash from investing activities. If you've invested in stock or you own property that you're collecting rent on, that is money that is coming in, but it's going to be categorized differently. There may be different tax liabilities that may be treated differently for accounting purposes. And then you've got cash from financing activities. So this is long-term liabilities in terms of, my 30-year mortgage on some of the equipment that I've got. Slide 39 talks about ratio analyses, and if you've taken accounting, you'll know what these are. A ratio is basically when you take one number and you divide it into another, and typically it'll be less than 1. If it's a 100% even, then it's 1.0. Again, if you're trying to compare one company to another, ratio analysis is also the way to do it. Go to slide 40 and we'll talk about profitability ratios. So I can compare a small company to a big company to find out who's actually more profitable. The big company may have mountains of revenue, but they may not be particularly profitable in terms of efficiency, where a smaller company with less revenue could be more profitable, and it may be something that I want to invest my money into instead. So the numerator, the top number, is the net income after taxes in millions. So if you go to the next slide, you'll see profit margin. That's basically the percentage of profit that you make for the money that you invest. So the profit margin on one side of the equation is the same as taking the net income as the numerator and then putting sales in the denominator. In this case, it's 1,245. That might be in millions or billions, depending on the company, or it could actually be $1,245. And then you've got 11,700 on the other side. So this is Starbucks. I'm going to be thinking that it's in millions. The profit margin in this case is 10.65. This would be a 0.1065 out of 1. So 10.65 means for every dollar that you sell, you get to keep about a dime. Profit margin of 10% is pretty good. Walmart, for example, has pretty much razor thin margins. If you did their net income over sales, you'd probably end up with a profit margin of 1.5% to 3% at best. So they have to sell a lot more stuff in order to make the same profit that Starbucks would, because Starbucks keeps a bigger portion out of every dollar in sales that they make. The return on assets is just another ratio. There's going to be a ton of ratios here, and I'm just going to explain how to do them. I'm not going to test you on it, but you should be aware that they exist. If you're taking accounting, I remember I took an accounting exam and I had an entire sheet of ratios. So I had the formulas written down. I would read the story, the facts of this particular company, and then they'd ask me to calculate all of this. That's not what this class is about, but you should be aware of what it is. So a return on assets is how much you're making for every dollar in asset that you have, not dollars in revenue or profit that you make, but all of your assets. What kind of a return are you getting? So in Starbucks, they make $1,245. It's the same number, but their assets, which is less actually, if you go back to the previous slide, than their revenues. This is the money that they've actually got a claim to. They make about 17 cents for every dollar in terms of assets. So that's also a pretty nice return in terms of the ratio that we're looking at here. Slide 43 is return on equity. This is return on the actual equity in the company, stuff that you own outright. Your net income divided by the stockholders' equity. This is how much stockholders own. They get a 28.39% return. So they get almost 30 cents on every dollar that they purchase in stock. Asset utilization ratios, how well you're using your assets. In slide 44, you can take a look at turnover, which is how quickly you sell stuff, your inventory turnover, your total asset turnover. Slide 45 does receivables. You take sales, you put the receivables in the denominator, you do the division. That means that they collect 30 times a year. They basically turn over all of their stuff. And if you think about Starbucks, what do they sell? They sell coffee. They sell a lot of it. They're not going to buy a year's worth of coffee in advance. So they have to buy their supply of coffee probably 30 times. That's because they sell so much stuff. So it's a very active company. Inventory turnover. Again, I'm not going to go through every one of these in a huge amount of detail, but take a look at the slides. It's basically the same thing. The equation means the answer is on the left side, and the way you get that answer is to do the math equation, the fraction here with the sales and inventory in the numerator and the denominator to produce that ratio. Slide 47 is asset utilization ratios. I'm going to skip ahead again. 48 is liquidity ratios. So this is how much money you have available or short-term assets that you could turn into money relatively quickly. Slide 49 gives you the current ratio, your current assets and your current liabilities. This is an indication of how much money you owe. So for Starbucks, that means that every dollar that they've got in terms of liabilities, they also have $1.83 in assets. So that means for every $1.83, I have $1 of debt. Now, if you have a company that has $2 of debt for every dollar of assets, you might get a little bit nervous because they have a lot of debt. And if they don't have a good cash flow, they may not be able to make their payments and they could default and go out of business. 183, that's not so bad. The quick ratio is something that people do to find out if a company is in good standing. So you take your current assets minus your inventory as the numerator. Your current liabilities are in the denominator. That means for every $1.36 that you have invested in assets, they've got $1 in liabilities. So again, they're still positive. They have more money in assets than they owe. If that was flipped, you might be a little bit nervous about investing in this company because they have a lot of debt. Slide 51 talks about debt financing ratios. Some companies like to keep their debt to asset ratios below 50%. If it creeps up closer to 80 or 90%, that would be a problem. Interestingly enough, if you look at the national debt of the country, which is essentially a big company, we have revenues coming in, we have revenue going out. Our GDP, after all of this bailout that's going to be going on through the pandemic, is probably going to be less than our debt, which means that we would have more than 100% in terms of debt to asset levels. We don't really have any assets in the government, but we would have the gross domestic product. So that would be the equivalent thing that you would look at. So as a country, we're starting to get into some dangerous footing because we owe more money than we make in any given year. Slide 52 has debt to total assets ratio. Again, I'm not going to test you on this, but it's just something that you can read through. You can look at Starbucks and you can look at different companies and do the same type of ratios, and you can get an indication of whether one company is performing more efficiently than another to give you an idea about whether you should buy stock or invest in that company. Slide 53 talks about times interest earned. Again, just read through it. I'm not going to go through it right now. Per share data is on slide 54. Again, take a read through it. It's kind of self-explanatory. Dividends per share is on slide 55 if you are interested in investing in a company. If you're not just going to speculate and buy it low and sell it high, you're going to hold it because you want to have a return on it through the form of dividends, you might want to figure out how much money they're going to pay you. So you take dividends per share, which is dividends paid as the numerator, the number of shares outstanding is the denominator, and you divide them in, and that basically means that you get 52 cents. You can basically read through that and go through the book. Again, I'm not going to cover it in the test. You should be aware of the vocabulary and know what a ratio is, however. Slide 56 just talks about a little bit how you can analyze a company. You could look at something like Netflix or any company for that matter. You can Google practically anybody and get most of this information for publicly traded companies. Because as we covered in Chapter 4, if you're publicly traded, all of this information has to be available to people who may be potential owners because they have a fiduciary obligation to share that with people who own it. If you do the industry analysis on slide 57, this is where you take some of those ratios and you can compare one company to another. McDonald's and Starbucks are very different, but if you look at the after-tax profits for McDonald's, it went up by 21%, while the after-tax profits for Starbucks went up by 300%. Now, that doesn't mean, if you look at the date, that's a decade ago, that doesn't mean that their profits are still increasing because their company may have matured and they may have calmed down in terms of how much money they're making. McDonald's has been around a lot longer. You wouldn't expect there to be a lot of after-tax profits at this point, but 21% is still very healthy. If you look at their current ratios, they're pretty good. Starbucks has a lower debt-to-asset ratio and has lower financial risk in that regard. If you take a look at slide 58, which is the last slide, you could look at all of these ratios and statements that they have between the companies if you're trying to figure out which company you would want to loan money to or buy stock in. Profit margin for McDonald's is about double that of Starbucks. The return on assets is fairly comparable. Return on equity, how much money they own, McDonald's has a better return. If you want to jump down to dividends per share, McDonald's makes almost 5 times the dividend payout that Starbucks does. So depending on what you're looking for, you may want to buy Starbucks because you think their profitability in the short term. They may have their stock price go up. So if you sold the stock, you could make more money. But if you want to hold the stock and live off of the dividends for income, McDonald's and that last line would be the thing that you would want to buy. So we're going to take a look at Chapter 15 next time. Hopefully, I'll be able to do the class live. If not, we'll be back to YouTube. Thank you.